I think the catalyst for when these explorers are going to start jumping out the gates is when silver breaks above $35 an ounce, because I think that will be the beginning of the FOMO, let's all chase gold stocks and anything with the word gold in their name, and that could cause these companies to explode.
Since the pandemic, the gold price is up more than 50%, while gold stocks are flat. For many years, it was enough to drive investors in gold miners mad. They were right about the gold price rising, but didn't profit from it. But in 2024, the relationship changed. Gold stocks began to match the price performance of the commodity they produce. The question is whether the gap between gold and gold stocks has now closed, or is this just the beginning of a major bull market? I'm joined today by a guest who has all the answers to these questions, and nobody puts their money where their mouth is quite like Brian Chu, founder of the Australian Gold Fund and editor of the Australian Gold Report. Brian, welcome back.
Hey Nick, how you going?
Yeah, it's good to see you. Good to get you back on. Gold's at record highs, so I didn't really have a choice. I had to go to you.
I think you got the second half right, where you said nobody puts their money in gold as much as what I do, as much as I do. But you're probably not quite right about I have all the answers, because I'm actually still asking a couple of questions myself. But yeah, it has been interesting watching the price of gold actually rise above $3,000 an ounce, and it certainly has happened quite quickly. Gold tripled in 10 years, doubled in 5. But gold stocks, they're trading at about 10% higher than their all-time highs in 2020. So if people actually bought just bullion in the last 5 years, they would have been much happier than those who bought gold stocks. But is there upside potential with gold stocks at the moment? I think it's we have to split into two bits. The first one is the larger gold producers, as in your Agnico Eagle, your Newmont, your Northern Star, versus the smaller companies such as the explorers and developers, of which there's hundreds of them. The upside potential is probably more in the latter category, while I think the market investors will more likely chase the former category, the larger gold producers, because they've moved up and they're familiar names.
So if we're going to argue that something's changed here since 2024, we sort of need to understand and explain what happened before that. So take us through this period of underperformance, what was behind it. I think we're talking about sort of during the pandemic and for that supply chain chaos period after as well, right? So up until 2024, what happened?
Yep. So most people in the market think that the performance of gold miners is driven by the price of gold. And it's actually only half the story. The other half is, of course, the expenses, the costs of inputs. And I believe that's more driven by the price of oil. 10 years ago, I asked the same question myself. How come gold is starting to move up after having been hit by in 2013 because of the Federal Reserve doing their yield curve manipulation? They called that, I think it was Operation Twist. That's right. And Peter Schiff loves to call Operation Screw, because he actually screwed the ordinary people over when they created an environment where asset prices were increasing, price levels were increasing, while real costs and real wages were actually not rising along with everyone else. So at that point in time, it was a similar situation. The price of gold started improving in about 2014, 2015 in Australian dollar terms, but gold stocks were slow in recovering. What happened in the midst of it was, of course, the price of oil. Now, gold stocks only started increasing when the price of oil fell by about 50%, as the OPEC countries sought to try to crowd out the shale oil industry in the US and Canada, which was booming at the time. I think most people remember the Permian Basin and the Canadian oil sands that started to boom in that area, and and it allowed North America to become a very competitive producer of oil and gas at that time, threatening the competitive position of the Middle Eastern countries and African countries who are producing oil. So as oil prices came down, the operating margins of gold producers increased. If you look at the gold to oil ratio, as in the number of barrels of oil that 1 ounce of gold can buy, that's actually now at 44. And on average, historically, it's about 18 to 20. So we're significantly above the historical average, and therefore gold producers are now very profitable. The operating margins normally would be about 35% or so, and we're currently operating on 46, 47%. That's led to gold stocks catching up to the price of gold in the last year and a half. But I believe that going forward, as President Trump's administration encourages more fossil fuel, encouraging the oil and gas industry to drill, explore, and produce, I believe that should keep the price of oil down at current levels, while I believe central banks are in a rate cutting cycle, and that is advantageous to gold. So the gold to oil ratio could likely remain above 35 in the foreseeable future, maybe the next 2 years or so.
It's an interesting idea that Trump is effectively boosting the gold miner shares with his energy policy. But the part I want to ask you about is, we used to have what you just said as a sort of a theory, right? We used to say the reason the gold stocks have underperformed the gold price is because their costs have gone up so much. We now have the data, the financial information for all those years. So did the AISC, the all-in sustaining cost, actually end up blowing out as we were theorizing at the time, or has there been some other part of the story?
So the gold to oil ratio and the operating margins actually have a 1 to 2 quarter lag. In other words, you can have whatever is the gold to oil ratio today would drive the operating margins of gold producers in the next 3 to 6 months. In 2021, 2022, as a result of the lockdowns, the global supply chain being crunched, and the Biden administration working alongside the World Economic Forum to try to phase out fossil fuels with their green agenda, the price of oil actually rose from about $45 a barrel at the time the Biden administration came in to as high as $120 a barrel in mid-2022. We also had the Russia-Ukraine conflict beginning in February 2022, and the embargoes and the sanctions against Russian oil and gas by the G7 nations and the European nations, blowing the price of oil further upwards to, as I said, $120 a barrel. The price of gold fell to about $1,600 an ounce from $2,000 an ounce between 2021 to 2022 because of the Federal Reserve raising interest rates very quickly from, I think the first rate rise was in March, and then they accelerated the rate rises in May 2022 onwards to as high as 5.25 to 5.5% in mid-2023. So that was what happened. The gold to oil ratio fell from about, I think, 35 in 2021, beginning of 2021, to as low as about 15 in mid-2022. As the rate rises subsided last year, at the rate rises actually, the last rate rise was, I think, in mid-2023. And then we started seeing the rate cuts in 2024, causing the price of oil to go down, price of gold to go up. All that contributed to the gold to oil ratio rising, operating margins rising, and the administration, the Trump administration, and the global economy in this current the direction that we're traveling, we are likely to see that gold could stay at around $2,800 to $3,000 an ounce and oil will probably be trading at between $60 to $80 a barrel in the meantime. So yeah, I believe that gold producers are going to enjoy a prolonged period of strong operating margins until there is a different game plan with OPEC trying to outmuscle the US and the Canadian oil production and try to push the oil price higher. We'll have to see how that arm wrestle goes.
Yeah, it's interesting because, as you say, it's always this balance between the gold price and the costs. So we haven't really had gold stocks hit the sweet spot, right, where the gold price has been rising and the oil price has been falling until recently. So that's the excitement here. Take us through some of the financial performance since 2024, because when I looked this up earlier today, I looked up the GLD, which is the gold ETF, and then the gold mine ETF, GDX, and they're trading almost in tandem. It's extraordinary how closely tied they are to each other. You follow some of the other ETFs and indices as well. Is that what we're seeing across the board?
Yes. So the GDX and the GDXJ, which are the international gold stocks, so that tracks, I think, predominantly the US and Canadian listed gold miners and the larger companies. So the GDX, I think, covers companies with a market cap of above $10 billion. And I think the GDXJ, because of the reach, I think we had a GDXJ issue back in 2016 where they no longer just track juniors, but they also had to include like a couple of $2 to $3 billion market cap miners into the mix. So that's now, I would say, a gauge of the mid tiers and the junior producers and a couple of late stage developers. So that's actually made a new high in the last 5 years, but it's nowhere near the all-time record back in 2011, 2012, when we had gold reach its record highs at that time of $1,900 an ounce. And all these companies were trading at crazy multiples. I remember some of these producers were going on drunken buying sprees of explorers at that time. And when gold fell out of its bed in 2013, these companies dropped like 80, 90%. And it was a pretty terrible time. Management in these companies have been more disciplined this time round. And therefore, even though we had a bear market in 2022, these companies didn't experience as severe a financial stress as they did. You could say that gold stocks are largely catching up to the price of gold, but that's only the larger producers. If you look at the smaller end of town, the explorers and the early stage developers, of which there's probably still about 100 companies on the ASX, I would say about 25 to 30% of these explorers and early stage developers are starting to follow the lead of the gold producers. The remaining 50% or so are still in a bear market. And what I mean by bear market is that they're not necessarily falling, but they're trading as if gold is in a bear market. That's where I see significant opportunities, because some of these companies have great projects. They have confirmed deposits. The ore grades of these deposits are actually quite economical if they can find a partner to fund them in their development. And that's why my newsletter readers in the Australian Gold Report, the ones who are buying the larger producers and earlier and late stage developers, I'm suggesting that they take some profits in this rally and shifting them to the explorers and developers, of which I gave them a sample of 3 companies. Whereas in Gold Stock Pro, our premium newsletter focusing on speculating on explorers and early stage developers, we are actually buying quite a lot of these companies and adding to our existing holdings in anticipation of them rallying. A handful of those companies have actually rallied 70 to 100% in the past 3 months. And we're looking for the rest of the portfolio to potentially follow suit in the next 6 to 9 months.
I just want to quickly go on a tangent here for our viewers who are outside Australia, because the opportunity is even bigger for them. We've got the Australian dollar sitting at awkward lows, and which means if it rallies back to more typical levels, investors from overseas buying Australian gold stocks would get the currency gain on top of the speculative gain in the share price. And I think this is probably the best opportunity going around. It's investing in the sorts of stocks you'd invest in anyway, but in Australia. So in the past, we've done an interview with Brian's colleague, Greg Canavan, about Australian coal stocks. Similar idea, this currency tailwind could add to your capital gains in gold as well, in gold mining stocks in Australia. So I can encourage everyone around the world, not just people in Australia, to check out these sorts of opportunities. Coming back to that story, Brian, I want to ask whether the financial performance, the quarterlies and the annuals since the beginning of this trend is confirming what you've been saying. Has the financial performance actually backed up this rally?
So for gold producers, yes, the average operating margin of gold producers in Australia in 2022 was about 35% at the beginning of 2022, fell to 29% in September 2022, and recovered to be about 33 to 37% throughout 2023. And 2023 was a grueling year in terms of gold broke above 3,000 Australian dollars an ounce, and then by the end of the year, gold was above 2,000 and almost hitting 2,100, and gold producers were lagging behind a bit. But in 2024, things changed when the price of oil fell from about $80 a barrel to $60, $65 a barrel. Gold broke above 2,100, and the gold to oil ratio broke above 35, and the operating margins went above 40% by the second half of 2024. Now, for the explorers and early stage developers, because they aren't earning any revenue from producing gold, they're actually still spending. They're a slightly different story because they're still putting cash into the ground and not quite taking cash out of the ground. So some of these companies had to raise more capital in order to keep the lights on and keep the drills operating. But the positive side is they can access financing a bit easier because the market is more receptive to them. So companies that are in more advanced stages of exploration and development were able to enjoy more financing opportunities, whether from joint ventures with the larger producers that are very cashed up now. So most of your Australian gold producers with annual production exceeding 100,000 ounces a year, they have more than $100 million of cash, and I'm already deducting any debt that they have. We haven't seen a time like this for at least 10 years where these companies are so cashed up. So they're going around providing, offering joint venture opportunities or processing agreements with these smaller explorers and developers. So you're seeing a trickle-down effect from producers enjoying, you could say, extremely profitable conditions, and that's trickling down to the smaller end who are now able to enjoy also access to funding where they had not been able to in 2021 to 2024, as other commodities enjoyed more favor, and that's where the funds went. So the funds are now cycling into precious metals mining.
Yeah, one way to think about this is that the key bidders, the key buyers of the junior stocks are the big ones, the big miners. Eventually, the question is whether they get involved in projects or start acquiring these small companies. For that to happen, they have to be cashed up, and obviously an increase in the gold price and a decrease in the oil price is the perfect opportunity for that. So you're moving your capital into those smaller companies in anticipation of that. But what I want to ask you about is going back to this sort of view back to 2020, we've still got the gold price up dramatically more than gold stocks. Is that opportunity still in play? Is that still relevant, or has the increasing costs for miners over those years, made that gap misleading? Has the alligator's jaws already closed?
Yep. So the way I would answer it would be from this angle. If you look at gold producers, they have run quite a lot. And the upside potential is not as attractive as they were back in 2022, 2023, when gold started recovering and these companies were down 50, 70%. So the market is largely pricing in the current conditions for gold producers as well as the outlook. I'm looking more towards the smaller producers, the late stage and the early stage developers and the explorers, because these companies are only starting to see the flow of capital into that space. And the price will hopefully reflect the potential that these companies have. But I always remind people that gold, even though it's money, it is still a commodity, and commodities go in cycles. So while gold is now in a strong bull cycle, how long will that last? I cannot guess exactly how long, but my estimate is that these wonderful days could probably last another 9 to 12 months, whereby I would use the opportunity to actually add more to the smaller producers, smaller developers and explorers in this rally. And should the ASX Gold Index rise above 11,500 points, so it's currently about 10,700, I would be taking more profits out of the producers, and I'll also be a bit more cautious about adding more to the smaller end of town. Now, should it rise further and go to about 12,000 points, I think depending on what the economic situation is, it would be time to make a quiet exit, because this would get a bit bubbly in my view. Even in these accommodative conditions, gold producers, there is a limit as to how much these should be valued relative to their potential. And I also have to keep a very close eye on the gold to oil ratio, because that will drive the operating margins and the performance of the larger producers, which in turn will feed back to the investor sentiment. My line in the sand at the moment is about 35, the gold to oil ratio. If the gold to oil ratio retreats below 35 and stays there for sufficiently long, then I think that is a sign the gold bull market is ending, and we are going to and people should be clearing out quite quickly before the rest of the market realizes it.
You're being uncharacteristically cautious here, Brian. I'm disappointed by the gold stock performance given the oil price and the gold price moves so far. The idea of gold stocks was that they provide leverage to the gold price, right? And in the last year or so, just over a year, we've sort of seen them trade in tandem. We've seen them highly correlated, delivering about the same price performance. So are they undervalued then, or were they fairly valued before the gold price and the oil price started moving? It must be one of the two, right?
Yeah. Now, I'm sorry to disappoint you, Nick, but I'm sure you did. I'm sure you said that in flippancy. Our aim is, of course, to protect our newsletter readers and our own wealth, rather than ride gung-ho with the rest of the market investors who don't benefit from our insights because they didn't pay for it. So the financial pundits out there are, of course, going to they're going to lean with the wind. They're going to write about what's hot. And whenever they start writing about what's hot, for us, it's not. And it's the other way around when they're talking about how is this the end of the love affair with the latest fad. Is this over? It usually means that that's beyond over and you should actually be buying right now. So in our case, with gold stocks, are they fairly valued, overvalued, or undervalued? I have to split into a few categories. The largest gold producers, I think the market follows them. The market is talking about how gold is very hot at the moment. I think they are largely fairly valued. With the mid-tier producers and a couple of the better performing junior producers, similar case. They are quite fairly valued because, again, the market's picked up on these names. You will see it. You'll read about it in Stockhead. You'll read about it in small caps in mining.com.au, and people are talking about it in hot copper. So that's priced in. There's still upside potential, but you're not going to gain the advantage over everyone else with that. It's the advantage of timing that you know when it's time to exit, when these guys are still coming in. On the developer side, we got a handful of developers that are now close to producing. These include, and these are not necessarily my recommendations, I'm just naming them because it's fact is fact. Astral Resources, Mika Gold, Black Cat Syndicate, Bright Star Resources, Rocks Resources. Those companies are bringing on mines for production. So those ones, the market is kind of pricing them in, but there's still opportunity. So I would say they're slightly undervalued. Then you got the more obscure names with the explorers and early stage developers with deposits lying there. Very few people are noticing, and there's only backroom deals being made. These boards are probably talking to each other, but they can't report anything. Those are very undervalued in relation to the rest of the market. And should the price of silver, and the reason why I'm suddenly bringing in silver, which we haven't talked about, reason why I'm bringing in silver is I think the catalyst for when these explorers are going to start jumping out the gates is when silver breaks above $35 an ounce, because I think that will be the beginning of the FOMO, let's all chase gold stocks and anything with the word gold in their name, and that could cause these companies to explode. So I think that's my answer, and that's why I'm cautious in one sense, but I'm also highly risk-taking in the other sense when it comes to gold stocks.
Well, Brian, thanks for helping investors discover this much maligned space. You've waited a few years for things to finally kick off in the gold mining space. They finally are, so congratulations on your patience. It's a good reminder that patience is a key skill for investors. And thanks for coming on.
Thanks a lot, Nick, and I hope our viewers will all benefit from these insights, and I hope you're also sitting on some generous paper gains and also taking some profits along the way.